Well, good morning. I'm Tim Sheehy, president of the MMAC, and welcome to the Business of Metro Milwaukee, a monthly webinar spotlighting the challenges and opportunities to growing the region's prosperity. Insights from this program will help you make better business decisions and help us all to better shape the region's future. Today's program is sponsored by United Healthcare. MMAC has partnered with United Healthcare to make it easier to find a health plan that works for your employees and your bottom line. You also have the option to add other United Healthcare plans to your employee benefits package, such as specialty plans and supplemental protection plans with groups for as few as 5 employees. You know, the best plug I can give this program comes from the 565 peer companies who have signed up over the last 9 months to provide coverage to more than 19,000 employees and their dependents. An MMAC affiliated broker can help you receive discounted rates on this United Healthcare level funded plan. So contact your MMAC broker or visit MMAC.org to learn more. Well, last month, I had an inkling we would be talking to Dr. Raymond this month about employees coming back to the office and operating with COVID as an endemic issue versus a pandemic. And Dr. Raymond is going to join us around 11:30 to do so. What I did not anticipate was discussing how a war perpetrated by Russia against its neighbor Ukraine would impact our world and our economy. Frankly, we all thought war in Europe on this scale was a relic of the 1940s. Now we see Wisconsin companies like Rockwell Automation, Harley-Davidson, and Twin Disc suspending business in Russia. Our state pension fund moving away from any Russian-related exposure. Now, Wisconsin has a small direct exposure to Russia's economy with 125 million in exports and 25 million in imports. But we are impacted by the growing inflation related to rising fuel costs. So it's very timely to have Don Rissmiller join us. Don is a partner and chief research officer at Strategas, an institutional brokerage and advisory firm serving clients in more than 20 countries around the world. Strategas is the market strategy arm of Baird. Don, I know you must be very busy on this topic and greatly appreciate your taking the time to join us today.
Well, thank you very much. So I'll share a few slides here with the group to get started. Appreciate the chance to be here. I'd say I put this presentation together at the end of last week to get it through the typical processes and get it ready to go. And you know, we sit here on Tuesday at lunch, and it feels like we're a little out of date. But the goal here is really I want to describe our thought process and give you some sense of how we would put a forecast together and what we're watching to gauge what are some pretty fluid geopolitical events. So the most immediate impact after the sanctions on Russia is it does look like Europe is heading for recession here. So Germany already looks like it's in recession. This will matter for any multinational exposure. The problem is we're not correlated in terms of the global economy. So the US economy, especially the US labor market, looks much more robust. And we saw this at the end of last week with the non-farm payrolls report. We see it every Thursday with weekly jobless claims. So in this disconnected environment, you could have a European recession, but what's coming up in the next couple of weeks is an FOMC meeting where the Fed may not be able to be as patient as we might like them to be if this were happening in a vacuum. If we were seeing these geopolitical events in a more typical time, the instinct would be for central banks to take a step back, wait and see, and judge the outcome. Here, we think they probably continue and are really set here to go on a rate hike cycle that is necessary. Now, this is a quick view of our economic forecast. And the first thing you see if you look at real GDP for the US is how choppy it's been recently. We've hit 2021 with a 6.5% real GDP pace, very strong. We fell to 2% in the third quarter before rebounding to 7% in the fourth quarter. And then as we look forward, our best guess is that you're going to weaken again here in the first quarter before trying to recover sequentially. So this very choppy GDP pattern is first off not normal, and second, what it's generating is some sticky pricing. So if we look at the core inflation metrics, they've moved well above any measure that we'd be comfortable with, and are set to stay there over the next few months. So the Federal Reserve has to be thinking about this in a framework where even with some geopolitical risk abroad, they have to plow forward. And so you could have rising food and energy prices at the same time you have rising interest rates, and that'll present a risk to future growth. So we do have growth slowing down as you move to 2023. There are parts of the economy that still have not looked normal. And I want to spend just a few seconds on this, because I think it helps in terms of determining where we go next to see how we got through the last 2 years. So this is consumer sentiment. This is the University of Michigan survey. And even without the war going on abroad, consumer sentiment has been weak. In fact, we've recently hit pandemic lows here on consumer sentiment. And this does matter. If you look at some of the recent research, this is from the NBER, saying anytime you get a 10-point drop in consumer expectations, you tend to be looking at a slowdown shortly thereafter. So this matters, but most of these other cycles were driven by typical business cycle items like durable goods and financial crises. And that's how you would typically get a recession. This was much more health related, as we know. But to look at some of the data, and I think this might be relevant to the local audience, this is the Milwaukee Purchasing Managers Indices versus total real gross domestic product. So a lot of the economy, when we look at the share of total, is contained in services and contained in consumer spending. But a lot of the volatility in the economy is contained in goods and in production. So the PMI measures are very good indicators of the swings, even if they don't represent the lion's share of what we're doing on the ground. It represents a large share of what moves and what affects corporate profits. So that's a typical cycle. This cycle was different to the extent that it really was not durable goods or a financial event that got us in trouble. It was services. So this is the TSA data on total traveler throughput. And you can see the collapse here as the pandemic hit, and only a partial recovery until you got to 2021 and had the vaccination efforts. But even then, with additional waves of health concern, you've had a very choppy pattern. And so US GDP, if we look at the overall economy, has recovered and is getting back to trend. So if we were here 2 years ago, and I think you went to the White House and you said, I have a plan to get GDP back to where it was on trend, I think we would have taken it. So there's a level of success that we've had getting the economy overall back to trend. The problem is, if we look at the total number of jobs, this is not there. There's still white space up here on non-farm payrolls. So we've had this GDP recovery without a recovery in jobs. And as we said, okay, well, we did not have a financial cascade. That helped. Also, the jobs that were cut were concentrated in lower pay positions, in-person services. So that mattered. Then the fiscal stimulus that's been applied to the economy over the past 2 years has been substantial. So that fiscal action made up the income difference. So goods sales, which would usually be where the volatility is, this includes online, which is important, but that part of the economy has done very well instead of driving the downturn. Permanent job loss was capped. And so household balance sheets here have come through this with a level of health that is not typical for a recession that occurred 2 years ago. So personal saving over the course of this pandemic period went way up as we transferred income. And so not having a financial crisis after the initial shock, this is the financial stress index from the St. Louis Fed, helped. We did not have a destruction of value in homes or a destruction of value in assets that drove households. So the fact that we did not have waves of financial events like we had waves of health events has mattered for household balance sheets. There is some very granular data we've been able to bring to bear on this. This was from a study done at Harvard in conjunction with some other institutions. Chetty, C-H-E-T-T-Y, is the lead author. And what you see is during the health cycle, different from other business cycles, Most of the spending cuts happened at the upper end of the income distribution, whereas most of the job loss was concentrated at the lower end of the pay scale. So we have this cycle where average hourly earnings went up. Pay went up. It went up first because you cut low pay positions. So that was this initial move up in average pay. That's a mix shift. But then we stayed there. And as we tried to rehire back into the service sector, into healthcare, into education, into leisure and hospitality, pay had to rise. So we've stayed above trend here in average pay for this entire cycle, which is odd. And the interruption was made up by transfers. So the blue line here is personal income adjusted for inflation. So this is real income. And you can see X transfers, this looks what you would think happened in the last cycle. Here's your dip, here's your recovery. A successful fiscal policy would have been filling in this triangle. Well, not only do we fill in that triangle, we put another triangle on top of it. So these charts are not supposed to be mirror images. They're supposed to be correlated, but we did so much work on the fiscal side that we more than made up the gap, and that money flowed to goods. So if you look at the composition of real spending, we had a whole lot of good spending, not much service spending. And what this has done is it's bottlenecked parts of the economy. We've really driven up the cost of goods, core goods in particular, which often don't move within the inflation metrics. And so we have to talk about something we haven't talked about in a while, which is inflation. We have not seen numbers like this in numerous decades. This is the CPI up close to 7.5% on a year-on-year basis. And we've seen a number of countries with this. Some countries in Europe have had more of a focus on the energy components. The US has had more focus on the labor component, but regardless, the bottom line is you can't have emergency monetary policy with this type of situation anymore. And so regardless of the international events, which do matter, which are important when thinking about the right central bank response, this is the M2 money supply chart, and it's a hockey stick higher. Monetary policy is supposed to have a symmetry to it. You cannot ease indefinitely. Monetary policy is not made to change your trend growth rate as much as it is to move growth back and forth in time. Your trend growth rate's determined by real fundamental factors, things that affect either hours worked or output per hour, getting you to trend output. So things that affect hours worked might be your immigration policy, your demographics. Things that affect output per hour would be your technology set, your human capital, your education system, your CapEx. Those are not in the monetary policy decision box. Those are taken as given. And so here, there's really no reason to be pulling growth forward into a supply constrained economy. These policies cannot make more semiconductors, they cannot make more oil, they cannot make more cars, they cannot fix pipelines. So the goal here, I think, is for monetary policy to try to get back to a neutral setting, and then hope the private sector can help as well. In other words, the path forward, and I'll use this as my last slide, is for both the central bank and the private sector and the international sector for that matter to work together to get the inflation picture into a more acceptable zone. And with that, we can see inflation moderate in a way that does not have to get into the stagflation issues we saw in the 1970s. So we'll continue to watch wage data. That will be important to us, but the Fed is set to go, and it's going to be the private sector clearing bottlenecks, limiting additional interruptions, managing geopolitical shocks that would get us to this softer landing rather than harder landing. But what we don't want to see is inflation become sticky. We don't want to see firms who might have experienced a 7% or higher price increase start to think that that's the new normal, say that every year from here on out is going to be that type of number. So if in future contracts, you're thinking price hikes are going to be 7, then 6.8, then 6.5, that's probably too high for the Fed. They're thinking more like 7, then 4, then 2. We need some sort of de-escalation, and that's going to come from the cost side as well. But that's the pathway to the softer landing in the economy. But those are my opening comments, but I also wanted to leave some time for questions. So why don't I pause there and see what else we can spend more time on.
Great, Don. Very, very concise, interesting update here. And if you've got questions, please pop them into the Q&A on the bottom of the screen here, and I'll feed them to Don. But Don, let me start out with, I saw a chart recently that showed the recovery of the stock market. In other words, how long it was down and how quickly it rebounded after a major conflict or a war, going back to World War II. And just kind of wanted your thoughts on it. The chart looked like there was a pretty quick rebound after these conflicts.
I think that's right. And geopolitical events and their impact on markets and the economy, the basic takeaway, I think, is that they're mixed historically. So what I think we have to focus on here is how much of an additional supply shock are we creating? So what's different this time is we're coming into this with central banks that have exhausted their patience in some cases. So Fed, Bank of England, Bank of Canada, and others. You're already turning more hawkish. So the problem here is if you have an additional supply shock, your instinct might be to try to look through it. Central bankers always want to try to look through supply shocks caused by geopolitical events, caused by wars, caused by other interruptions, natural disasters. But it's harder. It's harder because you've spent the last year looking through the supply problems we've already had. And so now any compounding factor is that much harder to look through because, again, the key question is, does anything that's going on seep into wages, seep into future contracts? And the more time we spend with these elevated prices, elevated inflation rates, the more likely it is that companies start saying, well, this is the new normal. And I got 7% last year. I'll try to get 7% this year. And that's very rational at the individual level and maybe necessary in some sectors. When it happens for the whole economy, there's an institution with a mandate to stop it. You're going to run into a wall because the Fed will tighten and they will, by their creation, by their existence, try to bring those numbers down. So the specific part that I think is relevant to today, what's different about this cycle is you basically spent the last year using the word transitory. So you've exhausted transitory. You've exhausted the leeway you would typically have for central banks to pause, to take the slow approach. I don't think you'd be lifting off if this event were happening in normal times without some of the inflation numbers we've seen that have already become elevated, without some of the labor market stress that we've seen.
Don, let me ask the question this way. Is there a way to, and maybe it's too simple to assign a percentage to it, but the question is the newest sanctions against Russia, what's their impact mean for business and consumers? You've just described a path we're on. How much impact is this having on that path?
Yeah, so I'll give you a quick rule of thumb. And so this is just a short approach, but if you take your mortgage rate and you add your gasoline price to it and you get 10, that combo sums to 10, usually we start to get in trouble as a country, right? So the problem right now is we have rising food and energy prices and rising interest rates. And so there's probably some leeway on both of those, but this is going to start to filter into consumer buying power, and then that'll feed back to companies. Two things I'd say. The volatility in these data is quite substantial, so you'd want to smooth it out. So really it's when you have an energy shock that lasts 6 months, some order of magnitude like that. And then there's a lead. I mean, these tend to take time to work through the economy. So if we think of a 6-month average of oil prices rising, that leading by 12 months, that's a more typical framework for gauging these metrics.
And so as we look forward, and I realize I'm asking you to kind of crystal ball this a little bit, but let's assume that this drags on for some period of time, this conflict. Do you think there's a permanent reset in oil in terms of where the U.S. gets it? Will this change our outlook?
So some of this is going to be a policy decision. Mm-hmm. So we have in the past used various sources of capacity. We have made a decision in the last year to use different sources of capacity, and we're telling a future story about even different sources, alternative sources of energy. I think the question is are those alternative sources ready for prime time? And if there's a gap that we need a bridge for, then the traditional sources are going to stay higher longer. High energy prices will not be inflationary automatically over the longer run, right? So high prices will be a relative price shift. It's perpetually rising prices that create inflation. Inflation's the change in the price that we're looking at. So to the extent our policies don't seem to mind higher traditional energy prices because that fosters alternative fuel sources, I think that there's a very good case that we're looking at a higher plateau, at least in the medium term, until new sources of energy can take over.
Sure. A question here about, can you break this down even more into layman's terms? If this will affect consumer spending, how exactly, and how will this affect the everyday person?
So it's going to hurt purchasing power, right? And that's where I'd say if your mortgage rate and your gasoline price sum to 10, you're probably looking at something that's bordering on recession. So you're going to be looking at job loss. You're going to be looking at the income effects that come from that, and then any leveraged players would get hurt there. So I mean, there's some leeway. There's not unlimited leeway here.
Do private business leaders need to temper their normal expectations of continual year-over-year improvement in earnings for the good of the overall economy, nationally as well as globally? And if yes, is that even kind of realistic? Is that a thought that could happen?
So two things I'd say here. The first step is going to be if you have exposure to Europe. Well, if you have exposure to Russia, that's obvious. But I'd say the next story is if you have exposure to European revenue sources, those are going to be quite impaired. You're already seeing it in Germany. And so the direct users of some of these energy sources in Europe are probably going to have trouble. I mean, the call for a European recession is not a terribly difficult call here. Now, a lot of U.S. company revenues and earnings are domestic. So the question is, does that filter back? There are a couple channels. So one is your export channel. And the second is the financial channel. So is there some leveraged player who had Russian assets? I mean, we did this in 1998. We went through this experience. So I would have to say, I mean, we tend not to make those type of mistakes time and time again. So having done it once, we seem to have learned from it, from that episode with long-term capital back several decades. So I don't think that's the most direct framework, but we're looking for contagion. Recessions are always contagion events. It's not so much that somebody's in trouble, it's that somebody's in trouble getting somebody else in trouble, getting your neighbor in trouble, getting their neighbor in trouble. And that's how you get the unexpected cancellations of orders, the unexpected changes in business plans. That's what leads to widespread layoffs, income cuts, and the problems of recession. So so I'd certainly temper earnings expectations if you have exposure to Europe. The other issue is, I mean, these are still nominal earnings. So I mean, there is some money illusion going on here, which is you might be able to make money, but the money's worth less. So we just have to be careful with that. So I'd say in the next few months, if you have set contracts, you might be thinking about what's coming in, but try to focus on your cost structure as well. I mean, if inflation is over 7 and wage growth is 4 or 5, I mean, that gap is helping companies right now, but that's not something that's very stable. Over time, the cost side tends to pick up. So just be aware of that when thinking about earnings expectations for the next few years.
Any advice for persons already retired and how best to weather the current and future economy as you see it today?
So, I mean, there's certainly the question of where the outlook goes, and do we resolve this war quickly? Really, does the global community, I mean, when we say we there, resolve this war quickly or not? Does that filter through to commodities, to oil, to nickel, to wheat? Should you be thinking about some inflation protection? I mean, that's out there. Adding commodity exposure here is probably tough. I think you've had a chance to do that. Whether you want to try to chase some of these blow off tops, I mean, that's not the best idea. Having some some cushion, some cash if the return to cash is going up because interest rates are rising. I mean, that might help. But if the Fed's going to be nimble, I think anyone in the market or the economy is going to have to be nimble as well.
Yeah. As you look ahead for employers, and you said that kind of transitory is a dead word now on inflation. What are employers looking at, do you think, in terms of wages as you look out over the next year or two?
I think the challenge is employers are looking at a labor market that's extremely tight. Yep. The U.S. labor market here is basically overheating. Mm-hmm. And there's not one thing wrong with it. There's probably half a dozen things wrong with it that are all compounding. So, there was a large health issue that matters for labor force participation. I mean, this particular illness affected older individuals more than younger. So to the extent labor force participation cuts off, there are retirements in the older cohorts. That was not the dominant variable, but there's impairment short of mortality. I mean, that's filtering through to labor force participation. There's still people feeling long symptoms of this, unable to work. We've seen a decrease in labor force participation. Beyond that, I mean, the pieces of the economy still are not fitting together the same way they did 2 years ago. So to the extent the education sector, as an example, is not functioning normally, that's has the potential to impede labor force participation. If a school is going to close for 2 weeks, or your child is going to be sent home for 2 weeks, and there's not another option, it's very difficult for both parents to be in the workforce. About 40% of family households will have a minor child at home, and there's about 10 million single parent families. So having options that either revolve around childcare or schooling or both, I think have been important and have not been available the way they were available 2 years ago. So getting that sector to heal, getting that sector to function normally, I think is important. There have been issues with how the health concerns are going to play out through mandates, through regulation on workplace. Again, none of these are the dominant factor, but the fact that we have half a dozen things all compounding labor force participation has meant that it's very hard to find workers. We have an elevated number of job openings. We have an elevated number of quits. We have a relatively low registered unemployment rate when we look at the series. So labor is scarce, and we see that in unemployment and underemployment. There's some evidence under the surface that it's getting a bit better, right? If we look at the number of people not in the workforce, which surged during the pandemic, that's starting to come back down. We're starting to see some labor supply show up, but there may be a speed limit to how fast workers are going to come back, given the evolving nature of the type of shock and the concerns that we've been through.
Looking ahead for the U.S. economy, what would you say is the biggest asset we have, and what's the biggest liability?
So we have a lot of assets for the U.S. economy. I mean, domestically, we have had the ability to increase productivity, and that's been important. Anything that changes output per hour is a pathway to raising aggregate living standards. So the fact that we have great companies that increase productivity matters. Internationally, what that means is the U.S. dollar has remained the global reserve currency. So of all the choices investors have globally, the U.S. is still a good destination for all the problems out there. There's money that comes to the U.S. to buy assets, and so having that means the U.S. can attract a large share of the globe's capital relatively cheaply at a relatively low interest rate. If there's going to be a flip, if that's going to change to a liability, because what this has meant is we've accumulated a lot of debt, but without much cost. It has not impeded our economy all that much because people want to bring money here. Investors want to bring money here globally. We have to be careful to protect that, I guess I'd say. In other words, if that were to flip, that would become one of our biggest liabilities. If we were to lose the ability to attract capital. I don't think that's likely. I don't think that's anything that's on the horizon. in the near term, but we should be good stewards of our fiscal situation for the purpose of keeping that in place, because it's one of our strongest positives.
Yeah, just maybe a last question here for you on the labor. Unexpected and early retirements have caused some of the overheating of the labor market and lower participation. But what about the impact of an overall less qualified replacement worker that handcuffs a business's ability to capitalize on opportunities? What are your thoughts on that?
Yeah, so there's a lot of work that's come out. The St. Louis Fed has done some work on excess retirements. The Dallas Fed has done some work on this. So it's been quite a developing literature on the excess retirements, and that phenomena is substantial and real. This is the economist's approach. So we don't necessarily say whether they're good or bad retirements. I mean, the good retirement would be, well, my home went up 20% in value and my stock portfolio is up, I think I can retire. A negative retirement might be I can't work. I have had a disease and I'm still ill in a way where I cannot function. So what we see is the exits, the exits from the labor force have increased, and that looks more durable. Some of that could flip, but it's slow and it looks to be small. In other words, if you've made the decision one way or the other to exit the workforce, I think that's a somewhat permanent type of decision, or at least you may not enter in the same way. So you have to have replacement workers. If that's the case, there are still some things we can do, though. I mean, we can think about capital for labor augmentation, if not capital for labor substitution. So capital for labor substitution might be, okay, in a restaurant, there's a kiosk or there's a self-checkout in a retail store. To the extent either software or hardware can augment the workforce, that's a way of making up for some of the skill mismatch as well. And we are seeing that if we look at the capital spending numbers have been increasing. So I think there's some of that going on as well.
Yeah, and then maybe another last question here on the currency. The question is, at some point, aren't constant sanctions pushing nations to leave the dollar as a reserve currency?
Yeah, it's a great question. We were thinking about this last week, writing about this last week. I think that's right. I think the process is still slow. So this is early. There may still be a global bloc that uses the dollar as the reserve currency. So we're not pushing away all of our allies. We're just saying if this was a store of value for everybody, maybe there are some asterisks on that. Well, maybe it's not a store of value if you're classified in this way, or have a central bank in this location, or hold your assets abroad. So I do think there's a very large change when we weaponize finance. I mean, that's different. I mean, if the foundation of credit, just the basis of it was trust, the words mean trust, there's some sense in which that's not as complete. It's complete kind of within a rule following system, but if you go declare war on your neighbor, that is no longer true. So we've hit a limit where even banks, central banks, finance in general, payment systems are part of this puzzle. So I think there will be interest in finding another alternative. It's hard to do, though. I mean, what is helping the dollar sometimes is called the cleanest dirty shirt analogy, or of all the alternatives, even if there are problems, other places have more problems. So that is working, I think, in the dollar's favor here, and that helps. But if you take a very long time horizon, I think we should give some thought to, will the dollar be around as the reserve currency forever? There's nothing preordained about that. There's nothing that guarantees that, other than the history we've been through for the last half century.
Well, Don, a very thoughtful discussion. I want to thank you for taking the time and Also want to thank Steve Booth, the CEO at Baird, who sits on the MMAC board, and Mary Ellen Stanek for steering us in your direction. It was a good call, and we really appreciate you taking the time to join us in a topsy-turvy point of the year.
Happy to. Thank you.
You bet, Don.